Jerome Powell and the Fed, they owe us an apology. If Jerome Powell were the CEO of a Fortune 500 company, he would have been fired a long time ago. His failure to act on clear warning signs helped ignite the worst inflation crisis in over 40 years. Then he overcorrected, crushing homebuyers, the mortgage industry, and millions of working families. Today, he's still holding the economy hostage with outdated logic and a refusal to course correct. In the wake of the pandemic, Washington unleashed an unprecedented economic stimulus, roughly $5 trillion in relief spending, on top of the Federal Reserve's own trillions in asset purchases. These actions helped avert a depression, no doubt about it, but they also set the stage for an inflation surge. Jerome Powell, however, downplayed the risk. As late as August 2021, with prices already climbing, Powell insisted that inflation was likely to be temporary. The Fed kept rates near zero and continued quantitative easing even as inflationary pressures mounted. Powell's transitory inflation call proved to be a costly mistake. The Fed relied on lagging indicators, especially housing data, which delayed necessary action. Rents were rising rapidly, but the metrics the Fed watched were slow to reflect real-time market changes. By June 2022, CPI inflation had soared to 9.1%, the highest in 4 decades. Powell later admitted the Fed should have acted sooner, but by then, inflation was embedded and a harsher remedy was inevitable. The delayed response eroded confidence not just in the central bank, but in institutional competence more broadly. To regain control, the Fed hiked interest rates aggressively from March 2022 through mid-2023, taking the federal funds rate from near zero to over 5%. Mortgage rates followed suit, jumping from 3% to nearly 8%, decimating affordability. By late 2023, housing had become more expensive than ever relative to income. First-time homebuyers, they were sidelined. Refinancing vanished, and the mortgage industry contracted sharply. The interest rate shock reverberated beyond real estate, affecting every aspect of borrowing from small business loans to auto financing. Consumers across the country felt the pain. Monthly mortgage payments jumped to $2,700 for a median-priced home, with incomes unable to keep pace. Credit card and auto loan rates climbed, groceries and essentials remained expensive, and economic uncertainty took hold. The Fed's overcorrection helped contain inflation, but it came at an enormous cost to ordinary Americans. The surge in borrowing costs not only strained households, it reduced business expansion, job creation, and slowed down the economic engine that had barely recovered from the COVID-19 crisis. The mortgage industry was thrown into the chaos. After a historic refinancing boom in 2020 and 2021, business dropped off a cliff. Thousands of loan officers, processors, underwriters, and support staff found themselves out of work. Real estate professionals saw transaction volumes absolutely plummet, and aspiring homeowners watched the American dream slip further out of reach. Builders paused or canceled projects. Small banks tightened lending. The cascading impact stretched from Wall Street to Main Street. Entire communities, particularly those reliant on construction, trade, seasonal tourism, began feeling the economic chill. In late 2024, inflation finally cooled. Headline CPI and PCE fell below 3%, and core PCE hovered around 2.7%. Unemployment crept into the 4% range, a sign of softening labor markets. The Fed responded with 3 cuts between September and December, totaling 1 full percentage point. It was a welcome shift, and on paper, the data justified it. But oddly, the expected relief in the mortgage markets didn't materialize. Mortgage rates remained stubbornly high, hovering around 7%. This puzzled many, but the bond market was reacting to 2 specific issues: a series of economic reports that seemed stronger than expected, and a brief uptick in the inflation readings. Payroll data showed job creation of 250,000 or more in consecutive months, while CPI ticked up slightly. These reports drove Treasury yields and kept mortgage rates elevated, despite the Fed's actions. But those reports didn't hold up under scrutiny. In early 2025, labor data was revised sharply downward. The supposed job strength had been overestimated. The government's more comprehensive QCEW report showed that nearly 800,000 fewer jobs had been created than initially reported from the previous 12 months. This wasn't just a statistical correction, it had real implications. The labor market was weaker than the Fed believed when it made its December decisions. Wall Street had moved prematurely based on the data and lacked integrity, and Main Street, they paid the price. As inflation readings resumed their decline and job gain slowed, the bond market began to adjust. Treasury yields started to fall, and as of spring 2025, mortgage rates dipped below 7%. It became clear the bond market had been misled by faulty data, and the Fed's cut had in fact been warranted. But by then, Powell had already shifted his stance again. Despite nearly identical economic conditions in late 2024, the Fed paused its rate cuts in 2025. Powell pointed to potential inflationary pressures from tariffs as justification. Tariffs on steel and other imports had recently doubled or were expected to increase. Powell warned that these might create a new wave of cost-push inflation, and so he advocated for holding rates steady as a precaution. This marked a dramatic shift in philosophy. For most of his tenure, Powell insisted on reacting only to clear, observational data. He famously said the Fed would be data dependent, but now he was suddenly forecasting inflationary risks that hadn't yet materialized. Critics called this selective and an inconsistent approach. The same Fed that waited too long to hike because it ignored real-time signals now seemed to be fixated on a theoretical threat. It wasn't just economists sounding the alarm. Industry leaders, mortgage professionals, and small business owners began asking tough questions. Why was Powell so willing to bet on hypothetical tariff inflation, but unwilling to acknowledge the very real pain being felt across the economy? Was the Fed overcorrecting yet again? Policymakers who once claimed humility in the face of uncertainty were now doubling down on the rigidness. The labor market, while still growing modestly, was weakening in unmistakable ways. Private payrolls, as measured by ADP, showed 37,000 jobs added in May of 2025, a steep decline from earlier in the year. In June, payrolls fell for the first time in more than 2 years. Weekly unemployment claims rose, and continuous claims climbed to nearly 2 million, the highest since 2021. Job openings also declined sharply. The once booming ratio of job openings to job seekers fell from 2-to-1 to nearly 1-to-1. Small businesses, once the engine of the post-COVID hiring, were reporting less urgency to hire. Surveys from industry groups showed declining expectations for future sales and employment. Tech firms, manufacturers, and even healthcare systems reported slower headcount growth. Taken together, this was a clear signal. The economy was cooling, yet Powell remained hesitant. The Fed's dual mandate is price stability and maximum employment. With inflation near target and employment softening, the mandate would seem to call for a more easing, not a pause. This disconnect between the Fed's guidance and the economic reality was growing more obvious by the week. Even the Fed's own data suggests a course correction. Real interest rates, nominal rates adjusted for inflation, were now signaling positive. That means money was tighter than it had been in years, even after the cuts. Holding steady risks choking off credit availability just when families and businesses need it most. The housing market remained stuck. Listings were scarce, affordability was poor, and potential buyers stayed on the sidelines. Builders slowed production, construction workers, contractors found less work, real estate agents faced another slow season, lenders already reeling cut more jobs. All of this was a ripple effect of the overly tight monetary policy. Meanwhile, Powell defended his cautious stance. He cited a need to see how tariffs play out. But the inflation data didn't support this fear. Core inflation remained stable. There was no surge in prices related to trade policies, at least not yet. By waiting on future inflation to appear before acting, Powell was repeating the mistakes he made in 2021, just in reverse. Instead of being too late to tighten, he risked being too late to ease. Powell's defenders urged that caution is prudent, but when caution turns into paralysis, the cost is real. Households delay major purchases. Business owners postpone hiring and investment. Consumers scale back. Confidence erodes. These are early signs of stagnation. an outcome the Fed is supposed to prevent. History is filled with examples of central banks acting too slowly to pivot. The 2008 financial crisis was preceded by policy that remained too tight for far too long. The early 1980s recession was deepened by the Fed's missteps. Today's Fed risks becoming another chapter in that history. Powell often says, if we get better information, we adjust. That mantra, once a promise of flexibility, now rings hollow. The data has improved, inflation has receded, labor markets are weakening, and yet the Fed clings to this defensive posture. The risk of inflation reaccelerating is not zero, but the risk of over-tightening is rising every day. The cost of inaction is mounting. Real estate, a pillar of wealth creation for American middle class, remains paralyzed. Mortgage professionals, agents, builders, and investors are watching demand vanish. Consumers are more cautious, credit is tightening, and the economic pulse is weakening. Without a clear signal from the Fed, risk aversion spreads, dragging down sectors that otherwise would be growing. The time for action is now. Another quarter-point cut would help reduce borrowing costs and show that the Fed is responsive. Even a strong statement of willingness to ease, if conditions persist, would be a step forward. Powell's refusal to acknowledge real damage being caused undermines public trust. Leadership is not about perfection. It's about adaptability in a face of new evidence. If Powell truly wants to restore confidence in markets, in housing, in the Fed, he must pivot. The lesson of the past few years is clear. Late decisions have consequences. In 2021, the Fed waited too long to raise interest rates and inflation surged. In 2025, waiting too long to cut could tip the economy into a preventable recession. With the right communication and forward-looking stance grounded in data, the Fed could still redirect course without panicking markets. Leadership isn't about always being right. It's about owning mistakes, adjusting, and putting people first. Millions of Americans are waiting. It's time for the Fed to stop looking backward or speculating too far forward and respond to what's happening now. A flexible, dynamic central bank is what the moment demands. The American public has already paid the price for the Fed's missteps. They deserve leadership that's willing to correct course when the data calls for it. Powell must act, acknowledge the damage, cut interest rates, and bring balance back to monetary policy before the harm is done and it's gone too long. That, my friends, is guaranteed.